do the analogy to technical analysis to flipping a coin. If you take an evenly weighted coin and flip it 1,000 times, the pattern that will emerge with each 1,000 flip sample size is a relatively even distribution between heads and tails. See, that's a pattern, because it'll happen every single time you flip the coin 1,000 times. But within that 1,000 flip sample size, is there any way that you can know for sure which individual flip is going to be heads and which individual flip is going to be tails? No. You could get 10 flips of heads in a row and be absolutely positive the next one's going to be tails, and it could come up heads again. And even though you can have all these streaks of heads and tails, in the end it's still going to come up 50-50. This is exactly the way technical analysis works. When you consider the diversity of the market, trying to predict what will happen next would be almost equivalent to sitting in front of a slot machine and coming up with some rational reason why you think that the pattern that you're looking for is going to come up on the next push of the button. It wouldn't make a lot of sense, would it? But the reason why we get fooled as traders, and we think of it in not this probabilistic way, is because when we put on a trade, we put on a trade for a reason. The problem is that when the trade works, we just naturally think our reason was right. What I'm trying to do here is help you disconnect any reason that you put on a trade with the reason why it actually moved. Because like I said before, there's almost never a relationship.